seen some incredibly good performance this earnings season out of the big money center banks, particularly J.P. Morgan. What about these regional banks? How'd they do during the second quarter? Well, this morning we got results from KeyCorp, the parent of KeyBank, has over 1,000 branches, Northwest, Midwest, Northeast. KeyCorp reported inline earnings on slightly weaker than expected revenue. The company put up stronger than anticipated loan growth of 5.5%, showed some credit improvements even as its net interest margin ticked lower. While the response to the news muted, stock lost 7 cents, closed at $11.61. I thought there were some real positives buried in the quarter. You got to look for them, though. For example, Key said that they expect to resume their buyback program once they finalize the recent acquisition of First Niagara. And the company also boosted its dividend by 13% during the past quarter. It's got a yield nearly 3%. That's a heck of a lot better than Treasuries. Plus, Key's book value, what it would be worth if it closed the whole company liquidated tomorrow, which it's not going to do, but it's around $13 a share. So it's at a nice discount. Let's take a closer look with Beth Mooney, the chairman and CEO of KeyCorp, find out more about the quarter and company's prospects. Ms. Mooney, welcome back to Mad Money.
Thanks, Jim. Good to be back.
All right, Beth, I feel like that 10 days from now, we're going to be talking about an entirely different bank because you're going to finalize the First Niagara. Just tell our viewers what the new company will look like, how big it's going to be, and how much savings you can wring out of this acquisition once you get through it.
Thanks, Jim. We're really excited. We are indeed. August 1st is the closing date for our acquisition of First Niagara. It will be a 40% increase in the size of our bank, and we will become the 13th largest bank in the United States, headquartered right here in Cleveland, Ohio. And it is going to be a solid return for our shareholders. We're looking for expense savings of at least $400 million, earnings accretion of 5%, a solid return on invested capital, and a nice boost in our return on common equity, as well as a significant improvement in our efficiency ratio. All around, I think it's going to be good for the clients, it's going to be good for communities, and good for shareholders.
Now, I know a lot of people are focused, as you do, on net interest margin. Yours was depressed. It seemed like when I read through the conference call that it was depressed in large part because of the fact that you couldn't do what you'd like to because of the merger. It's possible that that could go up in your next quarter once the merger's done.
It is true that banks saw some level of margin pressure this quarter with the lower, longer interest rate environment. But you're right. Ours was largely driven by excess liquidity as we get ready for the First Niagara merger. So prospectively, some of those pressures will abate, and we will see some improvement in margin as we go through the year.
Where's your loan growth coming from? Because it's stronger than most of the regional banks I talk to.
Yeah, you mentioned we did have strong loan growth of 5.5%, but it was really driven by a 12% increase in our commercial lending book. It was broad-based, it was across our geographies, and we had particularly strong growth in the upper end of the middle market. So what we see is companies are still willing to borrow. Although they're cautious, they're expanding through acquisition. They're willing to undertake financing. What we don't see is a lot of spending for capital investment. But we do see strong loan growth, and some huge piece of it is we're taking share.
You know, Beth, it's been so long that there have been a lot of acquisitions because, look, the big guys, frankly, are maxed out. They can't. So people forget that one of the principal ways that banks used to grow is by acquiring and taking out costs. You mentioned the $400 million figure. Could you, again, it's been so long since we've seen mergers. Talk about how that comes about, because that's a gigantic sum.
It's really part of the value proposition is that in this slow growth, low interest rate environment, the ability for two companies to come together, consolidate, and lower their expense base really creates meaningful growth, as you said. And for us, some huge piece of this will be an outsourced environment on the side of First Niagara, where they outsource their technology and operations. We'll insource all that, leverage it at a cost savings to us. We will lower occupancy costs because we have a lot of duplicative branches, and we'll be consolidating some 100 branches, lowering other costs, FDIC insurance, and across the board. So what we see is a real meaningful and solid path to deliver real cost synergies that are the core to the value proposition of how we've announced this transaction.
You have branches all over the country. Bank of America has taught us that you can start closing branches just because of technology. You spend a lot of money on technology, on mobile technology. At what point can you say, you know what, we don't need all this bricks and mortar, we can do it more efficiently and therefore save a lot more money for shareholders?
You know, we've been closing 2 to 3% of our branches a year for the last several years. So coming into this transaction, we brought down our total branch count by about 10%. And in early days, what we've done is we're just closing the 100 branches that are proximate to each other. But it is true, as consumers and businesses have a preference for mobile and online, you can do with less branch density than we've had in the past and still serve your customers. And we're rolling out just this quarter an enhanced digital experience across our consumer businesses and our wealth clients because it's a preference on how they want to do business with us.
All right, one of the things that I thought was great in the conference call, you talked about an actual workforce that's cheap and smart and good in Western New York. I'm not there. Most of our viewers aren't there. What do you mean by that? What, just an available pool of talent of well-educated people that you can put to work?
In many mergers, what typically happens is the former headquarters city often has a significant reduction in employment. And what we've been able to do, since this again is a largely outsourced environment on their part, we've looked and said there is a very strong headquarters workforce there, and we're picking up some new businesses to Key. They're a residential mortgage lender from origination to servicing. They have an indirect auto business, and what we're going to do is leverage that and make those the headquarters for those businesses for our entire franchise. And so we're going to be able to take advantage of the real talented workforce there and grow with them as we leverage these businesses across our franchise. And we're going to take some of our work that's outsourced and bring it back onshore and do it out of Buffalo, New York, because like you say, it's a real talented, low-cost, effective workforce, and we're pleased and proud to do so.
All right, last question. I know that the natural gas market in Ohio has been very, very strong, but I also know that it's been a stress business for both the suppliers and for some of the smaller operators. How are you positioned, and are you okay in terms of provisioning for oil and gas potential losses?
You know, first quarter was when the banks really took a long look at their oil and gas books and including their natural gas books. And we built our provision to 8% against our oil and gas loans in the first quarter. We feel we're well positioned. And as you know, prices are rebounding in the second quarter, and many of our customers have had access to lots of different parts of capital between equity offerings, sub-debt, and are really weathering this pretty well. So we feel good about our exposure in that industry and think it's coming back.
Excellent. Thank you so much, Beth Mooney, Chairman and CEO of KeyCorp. Always good to see you.
Thanks, Jim. Thanks for having us on today.
When this deal closes, this is going to be one of the cheapest stocks I follow. It closes August 1st. I really like Key very, very much. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.